Thank you for joining me for a quick look at what could be one of the hottest topics in the stock market at this time of year, and that's the Santa Claus rally. Now, the Santa Claus rally is simply an expectation for a gain in the last week of the year. And there's some reasons that we should expect that to unfold. One reason is tax planning. Many investors for years have expected stocks to deliver a gain in January. And that's related to rules about wash sales and capital losses and various other tax-related factors. So what we could be seeing in the last week in the year is investors trying to get ahead of the January effect. Now, Santa Claus rally could also be due to investors funding their retirement plans at the end of the year. That's fairly common. People adding money into those accounts, putting it to work, could cause prices to jump. Other potential causes could be window dressing. Now, at the end of the year, investment managers want to own stocks that they're proud to tell their investors about. They may not have owned them for long. That's why it's called window dressing. They're just dressing up their annual report with stocks that have done well through the year. And as they put that money to work, it tends to boost the indexes. Could also just be caused by a lack of sellers. A lot of large investment managers take some time off at the end of the year. They've already met their goals, bonuses are locked in. They just take a few days off, and without their presence, there's just not that much volume, not that much selling pressure. Well, there's reasons that there is the possibility of a rally. How big is it? And what we see is that in the last 20 years, S&P 500 has gained an average of 0.5% at the end of the year. Now, the typical gain over that time is only 0.2%. The Santa Claus rally does occur about 65% of the time, whereas in a typical period, we expect to rally 55% of the time. These are statistical edges, so there's a possibility to trade there. Now, when we look at other indexes, the NASDAQ 100, small cap stocks, which you can trade with the IWM ETF, not as large an edge. So the focus would seem to be on the S&P 500. Call options on the S&P 500 could be the best way to trade this. However, here's an important caveat. Right now, in 2018, the S&P 500 is below its 200-day moving average. That means we may not see a Santa Claus rally because on average, we see a loss during this time of the year when we're in a bear market as we are right now. That's really bad news because a lot of analysts believe if stocks fall in the last week of the year, the next year will include a bear market. Some notable examples: 2007, 1999, 1990, Santa Claus did not come to Wall Street, and the next year there was a bear market. There's too few examples to reach a statistically significant conclusion, but the Santa Claus rally could be a cause of concern in 2019. Thank you for joining me.